So let's bring in Nathan Bell. He's from Peters McGregor, and he's joining us from our Sydney CBD studio. Nathan, welcome to the program. Good to see you here for the first time, I think, this year. We can't start without talking about Donald Trump, the U.S. president-elect. It appears as if the Trump trade is on pause for now. Do you think that's justified? Considering we're still over a week from the inauguration, it's going to take time to get any policy initiated from here. Was the market just too, had set the bar too high for this media conference?
Look, I think you hit the nail on the head. The fact is that we have no idea what policies are actually going to get enacted over the next 4 years. The market's already tried to move ahead and priced in a lot of different things. I guess just generally it's more growth in a higher interest rate environment. But at the moment, there's actually no guarantee that anything is going to get done. So our portfolio has actually benefited quite well from the Trump bump. And one of the companies we own is Liberty Broadband. There's net neutrality laws, which, to cut a long story short, they might actually get rid of, which would actually give the company more pricing power. So we're actually very excited about that. But there's absolutely no guarantee that that's going to happen, and I think that's the same for a lot of industries, whether it's infrastructure spending or tax changes or what have you.
Do you have any of your portfolio positioned toward that biotech space or the big pharma space in the United States? Because it certainly appears, out of all of the things that Donald Trump could have talked about, and he has talked about in the past, that really did seem to be a focus today, or at least something that the markets could clearly hang their hat on.
Yeah, we've looked at a couple of stocks. It's not traditionally an area that we've invested in. The bigger issues over time tend to be the pipeline and what drugs the company's going to be selling in 5 to 10 years. A lot of companies are still facing pricing pressures regardless of what's going to happen with regulation. The healthcare sector generally is one that might actually do okay, even though we don't have a lot of exposure to it. People seem to think the sector's depressed, but if you actually look at the underlying valuations, they typically are very high. So I think the gains will be somewhat muted.
So it was about a 50-minute media conference being held by the U.S. president-elect. But again, a lot of focus was pulled away from policy to handle some of the salacious rumors that have been put out there about the president-elect, fake news, as he calls it. This is likely to be a hallmark of such a controversial president, that a lot of the focus perhaps is pulled to areas that, he doesn't necessarily want it to go to, that you as a market participant perhaps are not as interested in. But do you think, as somebody who's invested in the U.S., that you've got to get used to that and therefore plan, for this type of, conversation to continue?
Yeah, I think one of the biggest issues around the presidency these days is actually what they can get done. Obama had lots of what I would have thought were pretty sensible goals, and he tried to get them enacted through law, and they just didn't happen. Talking about gun laws there, for example. So the presidency doesn't actually have the power that the role doesn't have the power that it used to have, even though the Republicans do have a majority in the houses. So again, the question is, what can he actually get done? And he's actually got some very smart people around him. I know it's probably a great irony that a lot of billionaires are actually coming in to help him, which is funny given the people that tended to vote for him were the ones that were very anti-establishment. But these are very smart guys, and they'll have great ideas. And so I think the worst of Trump, hopefully, will be sort of pushed down because of the smart people surrounding him. But the question is, what are they actually going to get done? Because even within his own ranks, there are people who still oppose him.
But, you have to look at the facts, and so far, while it might just be sentiment indexes, certainly seems as if business is positive about this U.S. president, and that could potentially translate into actions that would help boost the U.S. economy, bring growth up, look for investment. So again, when you look at the U.S. overall as an investment opportunity, are you quite positive on how the lay of the land is going into this presidency?
Yeah, I think the interesting thing about the market is we've seen the actual sort of big broad indexes haven't been particularly volatile over the last 5, 6, 7 years. But if you look under the surface, there's actually been a lot more volatility in individual stock names. So we generally only have a portfolio of 20, 25 stocks. And over the last 18 months, we've actually added 13 names, 12 new ones and one that we've owned before. So that just gives you a bit of an insight as to, if you're looking company by company, there's a lot of volatility, and that's what you want as an investor. If you're trying to buy low and sell high, you need that volatility. So that's actually been a real positive for us over the last 18 months. And the higher the index goes and the higher the expectations are for earnings growth, I think that leads to more disappointments and hopefully more opportunities.
Okay, that's an interesting one because, of course, we're heading into quarterly reporting season in the U.S. We had Delta Airlines last night. We're looking forward to the big banks starting up on Friday with J.P. Morgan, Wells Fargo, and Bank of America. We had New York Fed's Dudley out speaking last night, saying that greater trustworthiness will make it easier for the financial industry to perform its role in supporting economic activity and rising living standards. Now, when it comes to the U.S. banks, we've got, I guess, a few interest rate rises already baked into the share price of U.S. banks. I think they're up about 18% since the election. Are you still invested in the U.S. banks?
So the one we own still is Wells Fargo, which has been in the news a lot last year. A lot of people will know. The one we sold more recently was Bank of America. Bank of America had the $13 billion legal settlement with the government for missold mortgages. And the company's share price has gone up from $12 to $23 since February last year. So it just shows how the market can be extremely volatile and how expectations have changed in such a short period. But with everyone starting to bake in higher interest rates, a lot of the big cost cutting done, and all the legal settlements done, I just don't think there's that much more upside unless interest rates go up much further than what people expect. We still hold Wells Fargo. We think it's a better quality business. And even though it's been scuttled in the newspapers recently, we think those problems will go away. So we still like the banking sector, but it's just about valuations. And 12 months ago, it was a very cheap industry, and now not so much.
Wells Fargo, you and Warren Buffett sticking by it through its troubles, its very real, not only PR troubles, but mistreatment of its customers. What is it in Wells Fargo that you see? Where's the opportunity there?
Yeah, I think this was a company that's traded on its reputation for a long time. But if you just look at it going through the GFC, it was probably one of the few banks that didn't really need any TARP funding, for example. And since the GFC, it's the only bank that's really got on to set record new profits. So it tells you, even though it really did muck up last year, there was a big failure by management, it's still an excellent bank. And I think if you're looking for what could really go right with this business, we're still only at about 1 million or 1.1 million new housing starts per year, and the long-term average is about 1.5, 1.6, which is underneath about the 2 million mark where it was pre-GFC. So even though it's been very slow, because I think we've still got a lot of slack in the labour market, a lot of underemployed people, if we can actually get, I think if interest rates do look like going up, you might actually see more people starting to think about buying a home a bit earlier than what they otherwise thought to lock in those low interest rates. So if that average goes more to 1.4, 1.5 million housing starts, that's going to be great for the banking sector, which is more concentrated than ever.
Okay. Perhaps we'll look outside of the US for a moment, because whilst we have developed markets, still in euphoria, relatively speaking, emerging markets are still pretty unloved. Nathan, do you see potential there?
Yeah, there's one stock in particular we own. It's part of the Liberty Empire, which the common denominator is a guy, John Malone, who's one of the richest men in America and is really the doyen of the cable industry in America, certainly for the last 40 or 50 years. And he's related to a Liberty company in South America. And the reason we like it is because it has great cable and broadband internet assets. And if you look at broadband subscription rates or penetration rates, they're only in the mid-20s versus in the Western world we're more like 45 or 50%. So there's a huge growth runway there. And one of the things we don't really like about South America and a lot of these other markets is they tend to be very risky, not just because of the individual businesses, because of the politics and the people involved with the businesses. But what we like here is we've actually got Western management running these terrific assets with a long growth runway. So we're very confident the management's going to do the right thing for us.
Okay, that's an interesting one. We don't talk about South America very much here on the channel. We do talk, though, a lot about the Asian region. I mean, we've had a lot of instability around the Chinese yuan coming through so far this year, although it seems to have quietened down, I suppose, in the past couple of days. How are you positioned in China?
Yeah, so the first thing is we have a couple of investments, but we've hedged the currency. We think the potential for a large devaluation is very real, and it may not be too far away. That said, we think there's a number of businesses there in China that even if the country was to have a recession and deal with its sort of housing surplus, I just think these businesses are going to be fantastic investments for the next decade. The trick is trying to pay the right price for them. But the one we like particularly is JD.com, which is a bit like the Amazon of China. What it does better than Alibaba is its delivery times are measured in hours, as opposed to days or potentially weeks. So we think that's a great competitive edge and run by a founder with his own money invested in the business. And we also own Baidu, which is the Google of China. It got in trouble late last year because a young student got some bad health advice and he ended up dying. And the experimental treatment was found on a Baidu website. So it's had to clean up its act. Growth has been zero, but we expect that to change over the next 12 months.
Okay, interesting. Now, just speaking of the next 12 months, I know we sort of touched upon it. In, I guess, the US in particular, I guess in all of your portfolios, we're looking for volatility, for opportunity, clearly. Are you still holding quite a lot of cash so that you can take advantage of these opportunities? How are you anticipating, I guess, volatility to pan out this year as compared to last year?
Yeah, look, it's interesting. I think this is such a contrast sitting here now compared to where we were 12 months ago when everyone thought it was going to be Armageddon. And then the markets ended up very strong towards the end of the year and up over the year. This time around, everyone's a lot more confident now. So maybe as the year goes on and people get less confidence in Trump, or if some of his policies don't get done, or maybe we might see the market sour. So we'd like more volatility, but as long as the markets are going up, there's more room for disappointment, and that's what we're trying to be making the most of.
So again, staying nimble through 2017. Nathan Bell, thank you so much for coming in. We look forward to chatting throughout the coming year.
My pleasure.